Okay, class. So I guess we can start our class now so that we can close as early as possible. So you're welcome again to another class on strategic business reporting. So tonight we're going to finish up on employee benefits. We started it on Wednesday. And if you'd remember, I told you that the employee benefits are the considerations, so any form of consideration that an employer gives to its employee for services rendered by the employee. Any form of consideration. And I pointed out that the only form of consideration, the only benefit that is removed from IAS 19 is share-based payment, is benefit relating to giving shares to your employees. That is removed because it is covered by another standard called IFRS 2. So just think of it, any benefits that an employer gives to its employee, and you want to learn how to treat it, your go-to standard is IAS 19. The standard categorized these benefits into four. There is the short-term employee benefits, there is the post-employment benefits, there is the other long-term benefits, and there is the termination benefits. These are the four categories of benefits that we can have. Last week on Wednesday, I have explained the first two. I'm going to finish up with post-employment benefits. And I can tell you for free that your exam is not going to come from short term. Nobody is going to ask you that. Your exam is not going to come from other long term. Nobody asks you that. Neither is it coming from termination. It is coming from post-employment. And you would agree that we spent a lot of time on that. I'm going to solve questions on post-employment benefits today. Now, for short-term employee benefits, I told you that these are benefits that are paid to employees within 1 year, like your salaries and wages, allowances, your profit share or bonus, maternity leave allowance, HMO. Think of any benefit that the employer has to pay to the employee within 1 year, within the period the employee has worked for you. For the service he has rendered, you have to pay him for that service within 1 year. That becomes a short-term employee benefit. And the accounting for that is just for you to identify when the employee has worked. So when the employer has enjoyed the service of that employee, then the employer has a liability and he needs to account for that at the due date. And the due date, meaning when he's supposed to pay that employee, by debiting staff costs to P&L and crediting an accrual account, in this case, accrued staff costs. So that's majorly how short-term employee benefits are treated. That's majorly how they are treated. You'd just establish, okay, has this guy worked for me? Has he worked for this money? Then I have to accrue for it, right? I have to accrue for it. And I also mentioned where there are upfront payments. There are some organizations that would pay some key allowances upfront. And we're able to identify that, then that becomes a prepayment. Then we credit bank, and which we're going to spread periodically over the period, right? Over that period for which that payment is supposed to cover, like that, usually 1 year or sometimes quarterly. So we also looked at paid absences, right? Where the employee will not be around, but we'll still pay him anyways. Still pay him. So we say that to account for it, we need to look at whether the payments can be accumulating or it is non-accumulating. If it is accumulating, it means that even if the staff does not take that allowance, that leave that year, we are still going to pay him anyways, meaning he can carry it forward to another year, right? That means that we already have it. We have a liability as soon as the guy is working. So you'll find out that at the end of the year, we'd usually do an accrual because we are owing the guy. Because we have to pay him as soon as whenever he decides to take that leave. So we accrue for that as well. But if it is non-accumulating, in that if he does not go for leave, we won't pay. Then at that point, we don't have a liability until the employee expresses intention to go for leave. Then that's when we would make an accrual in that wise. We moved on to post-employment benefits. I said these are benefits that we pay to our employee when they retire or at the completion of employment. And the popular examples are pension and gratuity. And I said that for you to account for that, we need to look at how these benefits are paid. Because these benefits are paid in the future. It's not something we pay like within 1 year, like for short-term employee benefit. These are payments that will be paid in the future. And these payments are usually huge. And in fact, they are governed by law. We have the Pension Reform Act that governs how you handle it. Because of the large sum involved, you find out that employer usually save for this money. And in Nigeria, the employer is required to take out 10% every month from their own hand and 8% every month from the salary of that staff, combine that together and remit it to a PFA. And in that wise, it means that for post-employment benefit, they usually have like a savings plan. So we call it plans. And this plan can either be a defined contribution plan or a defined benefit plan. Either ways, the employer is making contribution every month or per annum, depending. For the one that is a defined contribution plan, under this plan, the employer makes regular contribution to a plan, usually a PFA. And when the employee retires, he goes to the PFA and requests for his money. The employer does not have any further obligation beyond those contributions he has made. All the contribution he has made to the PFA, should it happen that the BFA is liquidated or is bankrupt and is unable to pay the employee, nobody can come to the employer under a defined contribution plan. The employer carries no further risk beyond the regular monthly contribution he makes. He has no further contribution beyond that. And in accounting for such plans, it therefore shows that the only liability that the employer has is those monthly contribution. It does not go beyond that. And that is what we account for. So at the end of every month, you only need to accrue for the pension payable for that period by debiting an expense, either to staff cost or you have a separate account head that you call pension expense and you credit pension payable. And when it is paid, you cancel out the liability by crediting the payable and debiting and crediting bank. like that. And it's usually no more than that for a defined contribution plan. The only exposure that the employer has is just those contributions because it's a defined contribution. It's the PFA that has the responsibility to settle the employee when they retire. You go and meet your PFA, not your employer. And that's what the Nigerian law supports. Now, the second one, which is a defined benefits plan. Under this plan, the employer has promised a specified amount of benefits to the employee on retirement. So the employer has said that when you retire, I would ensure that you get so amount as pension every month. He has committed. He has committed. In that case, right, the employer is now exposed to certain level of risk, like an investment risk, that the investments that would ensure that is able to pay those amounts when the employee retires is exposed to variability or changes or the loss that can arise on investment. Additionally, is financial risk. The risk that all investment he has made, that the money will now not be enough to ensure that the employee gets those amounts when they retire, or even actuarial risk. The risk that his calculation of the contribution he has to make every month was not correct. That when the employee retires, he saw that it's not adding up. He's exposed to a lot of risk because his obligation is beyond just contributing. His obligation now is towards the benefit. However, how do we then account for this? You see, in accounting for this, you guys told me that, yeah, because it's a future payment, then we need to discount it to present value. Then we recognize that in the books. I said, no. I said, yeah, that makes sense, but no, it will not fly because it's not automatic, right? Saying that we would ensure that you get certain amount when you retire as pension every month does not make it automatic. I mean, that statement is directed to only those that retires with the company, that stayed with the company till retirement, which is unlikely. Most people would leave. Some people would die. A lot of things would happen. So how do we then manage all that? So what we do is this. Accountants are not trained for all of these type of valuations because a lot is involved to know how we go about this. So what the standard recommends is that we engage an actuary. They are experts in actuarial assumptions. They can help us measure our obligations regarding this promise we have made. However, to ensure that whatever the actuary does comply with the conceptual framework, our own accounting principle, the standard recommends a projected unit credit method. In that, he has to do his valuations that he wants to do on a yearly basis in such a way that if a staff work for 1 year, then the employer has a liability to that staff for 1 year. And it continues to accumulate in that manner. So they call it projected unit credit method. So every year you work, you have earned a credit, a unit for yourself in the future. So peradventure that an employee leaves after or 4 years, then the only exposure we have to such an employee is just for 4 years. For 4 years. So we would have calculated that for since it's building up yearly, right? And that's how it really works. So the actuary does all that calculation and brings it to us. Then we do our accounting. We don't involve in all of these valuations because of a lot that is involved. A lot of variations happen. A lot of assumptions has to be made regarding our ability to really be able to meet up with that promise we have made. A lot is involved in it. So what the actuary gives us through an actuarial report, it gives us what we call a current service cost, which is that unit of benefits that the employee has created for himself in the future, which would then constitute our own expense for the year, right? That's our own expense for the year. So, and this is what we use to build up the obligation. So at the end of every year, we are debiting P&L with a current service costs, and we're crediting present value of defined benefit obligation with these amounts that the actuary has given to us. And mind you, these amounts, the way the actuary will have arrived at it is by discounting that amount from the future to present value. That's what they will have done. And that's why the credit is we're crediting PV of DBO, right? And I told you I won't be writing this in full. I'll shorten it as this. The actuary will also give us contribution, which is the contribution we would be making to a plan asset. Since we have established what we owe, then we need to then put ourselves together and start contributing towards that. It's the actuary that would also sort that out. And the way it happens in real life is that this contribution is usually made to PFAs normally because it's required by Nigerian law that is compulsory for every employer to do 18%. It's compulsory, it's not optional. So they do 18%. So if the recommended contribution by the actuary is higher than that, then whatever excess, they can then contribute it to either use it to invest in stocks, real estate, insurance policies, another investment as permitted by the Pension Reform Act, right? So also there is past service cost. I told you that this has to do with changes in the obligation, change in obligation for the services of the employee in the past. And these changes in obligation can either arise from an amendment or a curtailment. Amendment is when the employer introduces a new plan for the employees, which is a good thing for the employee. So this will usually increase the obligation for the employer because, they are saying that they will give them more. Why curtailment is a cancellation or discontinuation of an existing plan. This will reduce the obligation. So either of them, I've shown you how it is accounted for. So that's past service cost. Is more of a change in obligation. And there is gain or loss on settlement, which arise where there is a curtailment and the employer is required to settle the employees. So when there is curtailment, we need to settle. And what happens here is this. We would establish how much we owe the employee, what we want to settle it, what we owe them, what we have to settle, and we would negotiate a settlement price. In this case, you see that we negotiated that we want to close out an 100,000 obligation with just 90,000. So by implication, we are going to be making a gain of 10,000. and I asked you the entry. So you're able to figure it out that for this, since we are settling out, this will reduce our obligation. Our settlement price will to be taken from the plan asset, and we are making a profit that will go to POL. We could make a loss too. I mean, if we are settling for more, if the obligation is 100,000 and we are paying 110 or 120, that becomes a loss to us. Then there's interest expense. This usually arises as a result of unwinding of discount, because anytime we anytime you'd discount to present value, would usually have to unwind discount, and we do that through finance cost, and that's really what this is about. And of course, there's also benefits paid. This is when people retire, we need to pay them their benefits and all that. And I summarized it for you in a table, and I told you that when it comes to post-employment benefits, this table is everything. As soon as we're able to figure this out, then you're done. You're done with it. It's usually not beyond this, really. And I use this table to prepare POL, OCI, and statement of financial position. And that was what I taught you on Wednesday. It took us over an hour to do all of this. Now, let's use the next 1 hour to solve questions. But before I solve questions, I raised a very valid point last week when I was presenting the statement of financial position. I told you that the plan assets and the PV of DBO, we do not present them separately. You don't present the plan asset separately as an asset because it is not your asset, really. We don't present the PV of DBO separately as a liability because that's not your entire liability. Plan asset is not your asset because you're investing it for other people. It's not your money. You're not getting any benefit from it. So it doesn't meet the definition of asset by the conceptual framework. The same thing as obligation. It does not meet this PV of DBO, does not meet the definition of a liability in the conceptual framework, because that is not the amount we would settle. We already have an asset to net it off already. There's an existing asset. So what we do is to present the net. So we'll net off the asset against the obligation. If the asset is higher than the obligation, we call that a surplus, as you can see here, or you call that a net defined benefit asset. But if it is the liability that is higher, we call that a deficit or a net defined benefit obligation. So that's how it works. That's how it works. However, I need to bring your attention to something very important relating to surplus, because we're always very careful in accounting when it comes to recognition of assets. We never want to overstate our assets. I mean, that's the whole essence of IAS 36 on impairment of assets, because we do not want to overstate our asset at any point in time. We check it. And the same thing we do for this pension asset. So when you have a surplus or a net defined benefit asset, see, we really need to check if this is really an asset. Is it really an asset? Right? We don't have any problem with this net defined benefit obligation, because whenever the PV of DBO, which is your obligation, is higher than your plan asset, that shortfall is really your obligation. You owe that, and you have to quickly go and make up. Probably you do contributions and all that. It is your obligation. But where the plan asset is higher than the obligation, is that your asset? When I say is that your asset as an accountant, I mean that am I expecting any benefit from that? Because an asset is an economic resource, right? We need to be getting something from that item to describe it as an asset. Are we going to get something from it? If the answer is yes, fine. If the answer is no, take it off your books. It is not an asset. And that's where I'm going to start our discussion for tonight. But just to be sure that you are with me, let's have a 1 or 2 minute discussion on this. This surplus on or net defined benefit assets is what can the employer get from this for it to qualify to be an asset in our books? What is the benefit? Who can tell me? Can it be an asset or should we just remove it? Anyone?
So I was thinking that since it's like is the returns of the investment of okay, I want to run out saying what I'm saying. Okay, so I'm looking at it as like this money, this planned asset is not for the company. It's what we are supposed to use to pay the employee whenever the obligation is due. So, but we are just holding it and investing it in certain places for when that obligation is due, when that's when we withdraw the money and settle that obligation. But as we are investing it, the the investment is making returns. So that's what is causing this surplus. So that's why I'm thinking that this surplus is not that surplus is not part of what we're supposed to pay to the employee. So it should be for the company. So I'm thinking that's what is causing this surplus in net defined assets.
That's brilliant, Fashion. That's brilliant, but it's wrong. That income from that asset is not our own. It's still for the employees. Everything is their own. Whatever it is return we get on those money, we can't call that our own. Right? Yes, you are right that okay, that is what might be causing the surplus, but that money is not our own. So that is not what comes to the company. So any other person? Sharafa. Moses is not here.
Good evening,
Sharafa, do
sir.
you want to try? Yeah, how you doing?
Yeah, fine, thank you, sir. I don't want to think loud. I don't how do I put it. Okay, so as much as we cannot call that plan asset, I think as much as we can say it doesn't qualify as an asset, still it doesn't change the fact that we are only is like just reclassifying something from the money we can access anytime and just setting this one aside. So to me, until we are able to settle the obligation that it relates to, and so I don't know, it might just be a change of name. It's still like something that the company still owns somehow. So that's my thoughts.
That's your contribution. All right, no problem. Thank you. Okay. Okay, so nobody is able to figure this out. Okay, so let me start from there, right? So, the only benefit the company can get from here is just two, right? It's just two things. Number one is a refund from the plan. Refund. So the company can claim refund. Guys, we have over contributed. I mean, the contribution itself was an estimate. It wasn't like the actuary was dead sure that that's the precise amount. So when the plan asset becomes so excessive, it therefore shows with experience that the estimate of the contribution is wrong. So probably would request for refund, right? Or reduction in future contributions. Reduction in future contributions. Those are the benefits we can get. Those are the benefits we can get. So what the examiner can do, just to be sure that you understand what I'm saying, is that the examiner can actually give you, they will just put it somewhere in a sentence that because the plan asset is much more than the liability, the employer is entitled to a refund from the plan asset of so amount. Do you know that the reality is that if they tell you that the employer is entitled to a refund of 100 naira, and your calculation of this surplus here is giving you 1,000, do you know that your asset is just 100 naira? Yes, your asset is 100 naira. It can never be 1,000. That 1,000 is just a figment of our imagination that we're going to write off. We're going to write it off to OCI straight on. We're going to write it off to OCI. So that is what IAS 19 calls asset ceiling. It calls it asset ceiling. So just like impairment of assets, ensuring that the carrying amount is never higher than the recoverable amount. That's similar principle to this. So this is like our carrying amount. Those refunds that we can get or reduction in future contribution, that's like the recoverable amount. Okay, so you need to write it down to that. So IAS 19 calls it in his own parlance. He calls it asset ceiling, right? And when asset ceiling arises, we need to restrict this surplus to that asset ceiling. So you find sometimes the examiner might not even call it refund or reduction in future contribution. They can just say the asset ceiling has been set to 100 naira. If they tell you that the asset ceiling has been set to 100 naira, that means that is actually the benefit we are getting from whatever surplus that we have, and we restrict it to that. Okay, so that's just the only additional thing that we need to note. And with that, that is all about post-employment benefits. Now let's solve questions. So I'm going to solve this one first. This was a past question, and it was for 10 marks. It says that Dovetail Nigeria Limited is into production of cashew nuts for global consumption. The entity has 3,000 employees on the payroll who are qualified for approved defined contribution plan being operated. The company makes annual pension contribution of 28,000 by employee. 2016, the company paid total contribution amounting to 150 million, as well as 190 million and 54 million in 2017 and 2018, respectively, required. In accordance with IAS 19, how should the pension contribution be treated and accounted for in the financial statement of the company? Okay, so clearly, this one is a defined contribution plan because it is clearly stated in the question as such. And that is what they ask us to do. Now, how are we going to account for the pension? And it's quite easy because pension contribution is simply expensed for each year. But in this case, right, they told us that we have 3,000 employees. We're supposed to contribute for all of them. And we're supposed to do 28,000 per employee. So you are supposed to calculate how much is our liability per annum. First, you need to establish that. If you don't establish that, there would be challenges. So you're supposed to do your pension expense per annum, which is how much you're paying per employee, multiplied by the number of employees that you have. In this case, it gives us 84 million. And it is this 84 million that you take to P&L every year, and you accrue for that. That's what you accrue for as a liability. As a liability. So, how do you then deal with the fact that in 2016, the company made a contribution of 150? Why now? The contribution they are supposed to make is 84. So something is going to be happening in our pension, in our accrual account. Okay. This is like the accrual schedule or accrual GL. Right? Because on my GL, I will have accrued for 84 because that is how much I'm supposed to pay. But my guy paid 150. So this my accrual will be having a debit balance. Whatever. I don't want to. There are some of you that are not very good with double entry. So I just want to sometimes mention those terminology because you need them. You're an accountant anyways. But you could see that I actually drew up a table for this, which is sufficient in the exam. So I called it a prepayment because we have overpaid. So there is a prepayment of 66. So in your P&L, because the question says that, how will this be accounted for in the financial statement? So you're supposed to present P&L and statement of financial position. So in my P&L, what comes in as an expense is my liability, what I'm supposed to pay, the actual amount I'm supposed to pay, which is 84 million. That's my expense for that year. However, in my statement of financial position, I'm having an overpayment position. So I call that a prepayment. I have 66. Okay. So what happens in 2017? The guy paid 119 million. Again, overpayment. Son of 84 million. He paid 119 million. Don't forget that he overpaid last year. So there is an overpayment from last year sitting. Okay, we have overpaid. Now, he accrues for 84. That's his liability. He went ahead again and overpay 119. So now his overpayment has now increased to 101, which is like this plus this, all these overpayments minus the accrual itself. So overpayment of 101, which of course is carried forward to the next year. So in 2018, how much did he pay? Okay, he paid only 84 million. He paid only 84 million. Okay, so 84, he paid 54 million. So I accrued for 84. He paid 54. If you do 101 plus 54 minus what he's supposed to pay, actually, he's still in a prepayment. He's still in a prepayment position of 71. He's still in a prepayment position of 71. So, and that is why in my statement of financial position, all is coming in as a prepayment. All is coming in as a prepayment. So this was for 10 marks. It's for 10 marks. So I would expect all of you to get 10 over 10 in this. Hopefully, you'll be able to figure it out. Okay. Any question on this before I move to the next question? Okay, Yetunde, please ask a question.
Sorry, sir. I want you to start from that 2016 again. I'm trying to understand better.
20 what?
2016.
Yetunde, you're not nice. You want me to start from the beginning? It's okay.
I understood the 2018, but the 2016 and 2017, I don't understand.
Okay. So what they are supposed to pay is 84 million. That's their actual liability. So because they are paying 28,000 per employee and they have 3,000 employees, so it's 84 million. So in 2016, this is how you have like a schedule that would look like this. What we're supposed to pay is 84. That's our accrual. One leg goes to staff costs, the other leg accrual. So this is like an accrual schedule. So the pension cost itself is 84, but we paid 150. I mean, this is clear that we have overpaid. Okay. So there's a prepayment. So you can see in my P&L, what goes to P&L is the expense for the year, what we are supposed to pay, not what you paid. Accounting is not on cash basis. So what is your expense? What's your economic activity for that year? That's what goes to P&L. So in my financial position, I'm in a prepayment position. And this will be under assets. Let's say current assets. Prepayment is always under current assets. Like that. Okay. So now this prepayment is carried forward to next year. It's carried forward to next year. Again, next year, 2017, I will pay 84 million. I'll pay 84 million also. But how much did I actually pay? 119. So imagine I paid 119 again. There was a prepayment that we brought forward. Though. If you add these two together, minus what I'm supposed to pay. So there is an overpayment of 101 again. The same thing in 2018. We carry this forward. It paid 54. If you add it with this existing overpayments minus what it should have paid, there's still a prepayment of 71, which we presented as prepayment accordingly. As you can see, my expense for each year is what I'm supposed to pay. The 84 million is my expense because that's my pension expense for each year. Okay. Yesterday, did I help you?
Yes, perfect. Thank you, sir.
Okay. All right. Eko, can see your hand up.
Yes, sir. Thank you. I want to ask, how would the heading of this presentation be? Like we have financial statement of financial position assets in when presenting financial position, and statement of profit or loss for the year ended so period. How do we present the head of this? Or there's no need for heading?
Okay. There's already, I already owed statement of financial position. What you can do is an extract of SOPL. This one is an extract. Something like that. And you can do for the year ended also. It's okay because you're doing for 3 years. And I'm doing it in a columnar format. So this is fine. No special headings like that. This is just okay. It's just an extract. You're not preparing a full financial statement because they just wanted us to show how it to be treated in the financial statements, which is why I'm showing each of them. And how to do this schedule so that they can see the movements as it were. Okay. I think we can move to the next question. So let's do that. Now, the next question, this says that, this is also a past question. It says, at 4 January 2002, the fair value of the asset of a defined benefit plan were valued at 1.1 million, and the present value of defined benefit obligation was 1,250,000. On 31st December 2002, the plan received contributions from the employer of 490,000 and payout benefit of 190,000. The current service cost for the year was 360,000, and a discount rate of 6% is to be applied to the net assets or liability. After these transactions, the fair value of the plan assets at 31st December 2002 was 1.5 million. The present value of the defined benefit obligation was 1,553,600 required. Calculate gain or losses on remeasurement through OCI and return on plan asset, and illustrate how this pension plan will be treated in the statement of profit or loss and other comprehensive income, assuming a financial position for the year ended 31st December 2002. Okay. Now, if you look at this question, they want us to prepare all the statements. Everything I've taught you so far is embedded here. Not everything, but major part of it. As you can see, they already give us all the figures. They give us the figures at the beginning. They gave us the opening assets as this. They gave us the opening obligation as this. And at the end of the year, they gave us contribution as this, as 490,000. They gave us benefits. They gave us current service costs. They gave us discount rates. In fact, at the end, the fair value that the actuary did, even though they didn't mention the actuary, we know that these are extracts from the actuarial report. So at the end, we were given the fair value of the plan assets and also the fair value of the DBO. They gave us everything we need. So the first thing you must always do in the exam is for you to do this table. You have to, this is what you need to learn how to do. You have to do it. So I have plan assets, PV of DBO, and the net. Which is the net of these two. So at the beginning, which is the balance brought forward, what's the opening plan assets? It was 1.1 million. I put that under my plan asset. What's the opening PV of DBO? 1,250,000. I put that under DBO. All right. Now, after I've done that, I did my interest. I will advise you that in the exam because you might forget these interests. Immediately you do your opening, you would insert your opening into this schedule. Immediately do the unwinding of discounts, the interest expense or income. So in this case, it's like you're applying 6%. The discount rate given in the question is 6%. Just apply this 6% on the opening balances. So on the plan assets, if you apply 6%, it's 66,000. on the obligation is 75,000. What you need is the net. Is the net that we need. In this case, the obligation is higher than the plan assets. The interest on the obligation is higher than the interest on the plan asset. So we have a net interest expense. That's what we have. Also, aside those ones, we're given contribution. So this is where you need to ensure you don't make mistakes. This is where you need to ensure that you don't make mistakes. So by ensuring that contribution goes under P&L, I say P&L, goes under plan asset. Contribution goes under plan asset. If you go and put it in obligation, you are wrong. We usually contribute into a plan asset. Then we're given benefits paid of 190. When you pay benefits, you are going to take it out from the assets because that's where you have been contributing to anyway. So that's if you need to pay people, you take the money out from there. So the benefits will come out from the assets to settle the employees, which means that we are going to take it out from our obligation because it's going to then reduce our obligation. Finally, we're given the current service costs. You agree with me that current service cost is the obligation that we have every year. That's what builds up the DBO, defined benefit obligation. So it's usually added to obligation. And that is all. What is remaining is just these closing balances. That is all. So if you accumulate all the items under plan assets, you will get your book value, which I call carrying amount. Okay, in this case is 1.466 thousand. 1.466 thousand. If you cumulate all the figures under obligation, you will get 1,495 thousand also, and that's your book value. So, but what did he get? He did the fair value of the assets, and he said the asset is 1.5 million. He did the fair value of the obligation. He said it's 1,553,000. So you are going to compare that with the book value. We're going to compare that with the book value. So I put in my fair value here of the assets. I did the same thing to the obligation. So I will then do a comparison of the two because this is like a remeasure. Describe it as a remeasurement. It's like a remeasurement. So when I compared the fair value of the plan assets with the book value, I have 34,000. And you will see that the fair value is higher than my book value. And in this case, this is like a gain, is like an income. Income in the sense that the value of my asset has gone up. The value of my asset has what? Has gone up by 34,000. I will take it to OCI. It's a remeasurement income. We call it return on plan asset. For the obligation, you see that the obligation too went up because the fair value of the obligation is 1.5, while my book value is 1.4. So the fair value obligation went up by 58,600. That's a loss. That's a loss. If your base is going up, that's what the Yoruba people call it. If your liability is going up, it's a loss to you. It's a loss to you as an organization. So we call that actuarial loss. So it goes to OCI as well. But what goes to my statement of financial position is the net of these two. Mistakes that students will do is to go and take the net of the book value. That's wrong. You should take the net. You should take the net of the fair value. And it is the net of this fair value that goes to my SOFA. That goes to my SOFA. So, and that's all. That's what you will be required to do in the exam. Then let's prepare our statements. So, my P&L from this schedule, everything I need is here.
Sir, sorry to draw you back. I wanted to confirm what we are supposed to put in our financial position is the fair value, not the book value.
Yes, so the
Okay.
net of the net
Or
of
the
the
net.
two.
Okay.
Yes.
Thank you, sir.
You're welcome. So in my statement of profit or loss, what goes there from this schedule we have done? Number one is this interest. Is this net interest? Is this net interest of 9,000? Net interest of 9,000. And also the current service costs of 360. Just those two that goes there here. And that's what I took to my P&L, net interest expense and current service costs. Why I put the two in a jacket is just to show that they are both expenses. You can decide not to put it in jackets, doesn't matter. Then, in my statement of comprehensive income for the year ended, this period, which is the remeasurement and return on plan assets, 34, is because this is an income. That's why I didn't jacket this, just to distinguish it from those that are expenses. So, and also my actuarial loss, this would also come in as a loss here, as an outflow. And in my statement of financial position, I would have this. And because the obligation is higher than the fair value of the asset, so I have a net defined benefit obligation or a deficit. The obligation is higher. So, and that's why I'm having a deficit here. I'm having a deficit here under non-current liabilities. Under non-current liabilities. Just give me 1 minute. Just look at it. Give me 1 minute. Okay, back. Now, let's solve another question. This says that, it says, for the sake of simplicity and clarity, all transactions are assumed to occur at the end. It says the following data applies to the post-employment benefits, post-employment defined benefit compensation scheme of BCD Co. We're given discount rates of 10% each year. We're given PV of obligation at the beginning as 1 million. We're given market value of assets at the beginning of 1 million. And they said the following figures are relevant. So they give us, we're given current service costs, we're given benefits paid out, we're given contributions, we're given present value of obligation at year end, we're given fair value of plan asset at year end. So these are all what we were given. Okay, and now said additional information. Now listen up to this additional information because I'm going to ask you some things. It says at the end of 2003, a division of the company was sold. As a result of this, a large number of employees of that division opted to transfer their accumulated pension entitlement to their new employer plan. Assets with a fair value of 48,000 were transferred to the other company's plan, and the actuaries calculated that the reduction in BCD's defined benefit liability is 50,000. The year-end valuation in the table above were carried out before this transfer was recorded. Okay, who can tell us what is this about? What is this whole paragraph speaking to? Okay. Okay, we do not have that patience to wait. So this one is a curtailment, right? There is a curtailment here. The company has curtailed, it has sold a division, and it needs to settle some people, and he will be settling, the settlement price is 48. What he owe is 50. Okay, so apparently we are going to take 48 out of our assets, take 50 out of our liability, but there is a difference of 2,000. You can guess what the 2,000 is. That would be a gain on settlement that will go to P&L. That's a gain on settlement that goes to P&L because we have an obligation of 50,000 and we are settling with 48. It's a gain. We have made a gain. Settled with 48. So that goes to P&L. And that's what this whole paragraph is talking about. The next one, it says, at the end of 2004, a decision was taken to make a one-off additional payment to former employees currently receiving pensions from the plan. This was announced to the former employee before the end. This payment was not allowed for in the original terms of the scheme. The actual valuation of the obligation in the table above includes the additional liability of 40,000 relating to these additional payments. So what is this paragraph talking about? So this one is talking about, is an amendment here. There's an amendment because we are going to be doing a one-off additional payment. So in addition to what we have promised you, we are going to give you a one-off payment, right, when you retire. So, and we're doing 40. So our obligation has increased by 40. And what is that? That is a past service cost. This 40,000 is a past service cost. It's a change in obligation as a result of an amendment. And that is all. So every other thing is just very straightforward. Just that this one is for 3 years, but it's still the same thing like I've done before. So for the first year, I drew up my schedule. I have my plan assets, I have my PV of DBO. And then in net, I put in my opening figures as gotten from the correction, 1,000, 1,000. Like I told you, always do your interests. So I just applied 10% of this. So since these two are equal, so 100, 100, no net. they gave us current service cost of 140 in the first year, and current service cost is added to our obligation. Then I was given benefit paid out of 120. Again, you take that out from the assets. You also take it out from the obligation. That's your benefits paid out. Then the contribution you paid, which is this 110, pay contribution of 110. This is usually paid to, it's added to a plan asset. Okay, and that's all. So I just cumulate the two columns together. My carrying amount for the plan assets gives me 1,090. This one gives me 1,120. I compare it with the fair value that they gave me at the end. They gave me the fair value of the two. For the obligation, I was given 1,2. For the asset, I was given 1,250. So I bring in those comparison here. The asset, 1,250. Obligation, 1,2. Again, the fair value of the plan asset is higher. It has increased, which is an income for me. I call that return on plan asset. And again, the obligation has also increased. Obligation has increased as well by 80, and that's a loss. My BC has increased. I'm owing more. That's a loss. I have a loss of 80. So this two goes to OCI, and the net of the fair value will go to statement of financial position. In this case, the asset is higher than the obligation. This will be a net defined benefit asset or a surplus. And from here, for the interest, nothing is going to P&L because the net is 0. My current service cost goes to P&L, and that's the only thing that goes to P&L for this year. Just my current service cost. In the next year, 2023, my opening balance will be the closing balance of last year. And what are the closing balances of last year? Is the fair value. I'm going to use the carrying amount. So you know that we have remeasured it to this amount. So that's what will become the opening balance in the next year. So the first thing you do is to calculate your interests at these rates at 10%. So we have 125 here and 120 here. The asset is higher. So this will be a net defined, what am I saying? This will be a net interest income. It's a net interest income. So I was given my current service costs as 150. Benefit paid out, you remove it from the two. Contribution paid, you add it to the plan asset. And in 2003, so that I won't forget, there was a curtailment. You take this out from the assets. You take this out from the obligation. The difference goes to P&L as a gain on settlement. And that's why these guys are coming in. 48, 50. 48 is out from the asset. 50 is out from the obligation. So this 2 is a gain on settlement. It's a gain because an obligation of 50 is settled with just 48. I've made a gain. Imagine you are owing somebody 50 and they say, yeah, pay only 48. That's what this is about. Okay, so let's cumulate all the columns for assets and obligation, which I call carrying amount. For asset, I got 1,307. For obligation, I got this, 1,280. So I'll compare that with the fair value given in the question. So in the question for year 2, for my obligation, 1,650. For my assets, 1,450. Those are the figures they give me. Asset 1450, obligation 1650. But I have to take away this 48 from here as well, because they have not taken it away before. And since we have removed it to arrive at this carrying amount, I have to remove it. They didn't consider it. Look at it. They said the year-end valuations in the table above were carried out before this transfer was recorded. So the year-end valuation, this is what they are referring to, the valuation of the asset and liabilities. They were done before this happened, before this curtailment happened. They were done before the curtailment happened. So if the curtailment had happened before this valuation, they actually will have considered it. So since it hasn't, so we need to remove the 48 from here as well and the 50 from here as well, so that the new fair value we are having at these amounts. Again, the plan asset here is still higher, so it's an income. The obligation here is still higher, is a loss. And the net of these two is what goes to my statement of financial position. In this case, the obligation is higher. So we have a net defined benefit obligation or a deficit. So in the final year, again, this is what will come in as my opening figures. I determine my interest, like I've always done. My current service cost is added to my obligation. Benefit paid out is taken out from the two. Contribution is added to the plan asset. And these notes in 2004, I told you is relating to plan assets because it's a change, an increase in obligation. Is an increase in obligation. So I have a plan assets, a past service cost that I added to my obligation. That's it for that. So I accumulate it to get this carrying amount, which I compared with my fair value. Okay. Again, the fair value of the assets is higher, so this is still an income. In this case, the fair value of the obligation is now lower. So this becomes an actuarial gain. Okay. So the net of these two is what will go to statement of financial position. So and I prepare my statements. What goes to P&L are all the service costs for each year, the net interest expense or income for each year, past service cost, and gain or loss on settlement. And what goes to my OCI for each year is my return on plan assets and my actuarial gain and losses. Okay, for my schedule above. And my statement of financial position is the net or deficits, the surplus and deficit. So in year 1 alone is when we had a surplus. In year 2 and 3, what we had was a deficit. So it's really nothing special. It's really nothing special that we're dealing with here. Just normal arithmetic. And that's the end of this question. That's the end of this question. Any questions? Any questions? Any questions? Okay. Let's solve one more question, then I'll allow you guys go. Most of you might be tired. Let's solve one more question. Now, this one has to do with asset selling that I explained earlier. Okay, yesterday, please ask your question.
So you mentioned earlier that you might not use to write ledger. So I'm trying to confirm, is it compulsory you have this written in ledger or taking from your bank?
No, it's not necessary. Don't do that. Yeah, David.
Oh, sir. Sorry, I wanted to ask, do companies really practice this defined benefits?
Yes, they do. Yes, they do. They do.
Like
I've,
examples.
I've actually seen it. I've gone to audit such a company before. Me too, I didn't know. So I've actually done this in real life. And the way I've explained it to you is exactly how it is done in real life. So when we saw the substance of their contribution, and they explained that they have assured their staff certain amount of pension when they retire. We said this is a defined benefit plan. And immediately we wrote them that they should engage an actuary to value that plans. So the actuary sent us a report and we're able to do this schedule, incorporating in their P&L and all that. So yes, they practice it in Nigeria. Now let's look at this question. It says Apolline Co. manages a defined benefit scheme for its employees. At 4th January 2008, the fair value of the pension scheme assets were estimated to be 137 million, and the present value of the pension scheme liabilities were 122 million. The asset ceiling has been calculated at 4 million. The discount rate on high quality corporate bond is 4%. The following rates are the details of the scheme for the year to 31st December 2008. So we're given contribution, benefit paid, current service costs. We're told that at 31st December 2008, the asset ceiling has been calculated at 11 million. During the year, there was a scheme curtailment which resulted in a gain on settlement of 3 million. Immediately after the scheme curtailment, they actually valued the scheme's assets as 148 million and the scheme liability as 136 million required. Account for the above transaction for the year ended. Okay. So the only thing that is different here from everything I've taught is the mentioning of asset ceiling that they mentioned. Every other thing is just the same. And at the beginning, there was an asset ceiling of 4 million. At the end, there was an asset ceiling of 11 million. And why is there an asset ceiling? Because we were having a surplus. You will see that the scheme asset at the beginning is higher than the scheme liabilities. So this one is from last year. These are the beginning. The asset ceiling is 4 million. So whatever it is they will recognize in the statement of financial position cannot exceed 4 million. Any difference will have been written off to OCI as a ceiling adjustment. The same thing we are going to do this year because now they are giving us our asset ceiling. And even by mere looking at itself, the asset is 148, liability is 136. So it's like a surplus of 12 million. But they are saying no, write off one. And because the asset ceiling is 11, so we're going to restrict our surplus to 11 million. And that's really what's special here. Every other thing remains the same. But just to fulfill due diligence. So opening, I have my opening assets, 137. Opening liability, 122. So I have the nets. All these ones really not necessary for you, but I mean, since there was an asset ceiling of 4 at the beginning, so the 11 will have been written off to OCI last year. We call it ceiling adjustments. Ceiling adjustment. So my interest, ordinarily, what I need is this. I can just say 4% of this, but I really need to compute these two as well. Just that when I'm getting my carrying amounts, this too is impacted. So I did 4% of this opening, 4% of this as well. So that's what gave me this. So I will have a net interest income because the interest on the asset is higher. Then is the net, whatever interest that go into P&L eventually will be based on what was recorded in my statement of financial position. So that's why I have this 0.16, which is 4% times this 4. I just fill in the gap with the difference. Just this minus this. That's what gives this. Really not that important because I'm not going to use it for anything. And that's it, really. Then contribution to my plan asset, 7. Benefits paid, take it out from the 2. Then current service costs, obligation. Now, there was an asset ceiling, but before that asset ceiling, you say there was a scheme curtailment resulting in a settlement of 3 million. Okay, not just a settlement, a gain on settlement. So this gain on settlement, I know is going to P&L. If I just take this to P&L, and I don't acknowledge the fact that this gain is arising because we had a liability that we settled at a savings of 3 million. We settled it at a savings of 3 million, though they didn't give us those amounts. So I'll assume that, let's say the liability is 3. So we settled for 0. And I just assumed, right? Because they didn't give me, so I really have to do this. Otherwise, my carrying amount will be wrong. So I need to show the net impact. So, and that's how this gain that they told us here was arrived at. A gain of 3 million. This gain of 3 million means that we had the liability that we agreed with the employee to settle at a savings. We made a savings of 3 million. We made a savings of 3 million. So, and that's what I've represented. That if the liability was 3, it means we paid 0. So we had a gain. And that's all. So I get my carrying amount. I compared it with my fair value. Okay. The fair value is higher, so we have an income. The liability is higher here. We have a loss. We have a loss. So this goes to OCI. Then the net should go to my statement of financial position, which is a surplus. But since there was an asset ceiling of 11, so I restrict it to 11, then I will write off 1, which is 12 minus 11 majorly. So my POL, my net interest income, this one, goes to P&L. My current service costs, this one, goes to P&L. And gain on settlement goes to P&L. My OCI, return on plan asset and actuarial loss. And also my ceiling adjustment of 1, that ceiling adjustment here at the end. Then my statement of financial position, it was a net defined benefit asset or a surplus of 11, because 11 is the ceiling, the asset ceiling. So that's what I will put in my statement of financial position. Not the 12, but the asset ceiling. And that's the end of this correction. While you take this home as your assignment, just this one. Most of your exam questions are easy. You can just scan through. Last time they asked, last diet, was it there? No, I know it was there 2 diets ago. Can't remember. Maybe it's there last diet too. Can't. There's a frequent in your exam, post-employment benefit. And that's where I'm going to stop tonight before you all sleep on me?
Sorry, I thought we're not using this 0.16.
This one,
Mm.
that's the net interest. Since this is the asset ceiling, this asset ceiling is 4. So whatever interest is to be calculated on the opening balance. This is the final balance of those openings. So this is actually what goes to my P&L. Reason why I'm doing all of this is just because they will have an impact on this carrying amount. That's why I just have to do this, right? But the major thing that we need is the net. You should see in all the questions we have done is the net. Ordinarily, I will have used these nets, but because of this asset ceiling, I have to use, this is what was recognized as asset last year. So it's on it, I'll calculate my interest eventually.
Thank you, sir.
You're welcome. Okay, I will see you tomorrow. Try to do assignment. I sent a question to your group. Try to solve it. Try to revise. If you check our notes, it's going to almost 300 pages. By the time we finish group account, this note will be 300 pages already. It's a lot already. And if I were you, this is what I'll be using for my study. Everything I need to study. If there's anything additionally that I require, that will be a past correction. To be very unwise of you to now go and buy one big book when you have a textbook that I'm writing live in front of you. Live. So the only additional thing you need is past questions to solve much more and more questions. You would pass. Just try and keep it simple. Revise everything we have taught you, and you do well. We still have a long way to, not so long way to go, really. By the time I'm done with group accounts with you guys, and that will take me like 4 weeks. It might not even be up to 4 weeks. But worst case, 4 weeks. And I might be starting it next week. In fact, I will start it next week. I will just hit the ground running on Friday, next week, Friday. And we would see how we can make a few sacrifices just to finish it up. And I'll try to solve like some past questions with you just to show you how it is really applied. Okay, guys, thank you. See you tomorrow evening for those that are taking case study. Have a wonderful night. Bye.
Thank you, sir.